Welcome to The Explainer. Today, we're unpacking a corporate maneuver that, honestly, leaves a lot of investors scratching their heads. The rights issue. Just imagine waking up, checking your email, and finding out your absolute favorite brand has sent you an exclusive VIP discount coupon. But there's a catch, right? It only applies to shares of a company you already own. And what you decide to do with that coupon, well, it can directly impact your portfolio's value. So is it a gift? Is it a necessity? Or is it a warning sign? We're going to break down exactly how these things work, the math behind them, and why companies even use them in the first place. Okay, let's dive right into this. Here's our quick roadmap for this explainer. First, what are rights issues? Second, traditional versus renounceable. Third, the 3 shareholder options. Fourth, the math breakdown. Fifth, the timeline. And sixth, why companies actually do this.
All right, part 1. What are rights issues?
So what are we actually talking about here? Basically, a rights issue is an offer from a company to its existing shareholders. It gives you the chance to buy additional shares at a discounted price. Think of it exactly like that exclusive VIP discount I mentioned earlier, handed out only to loyal customers. Companies use this to raise fresh cash without having to go out and beg the general public. And for you, it helps prevent your ownership stake from getting excessively diluted just because they needed to raise some capital. Our source material sums it up perfectly right here, calling it a strategic way for a company to raise capital from existing shareholders while offering them preferential treatment. And that's the key phrase, preferential treatment. But you do have to keep in mind that while you're getting a sweet discount, dumping new shares into the market can actually decrease the company's earnings per share. Simply put, the exact same profits are now just being divided up among a whole lot more shares. Moving on to Section 2, traditional versus renounceable. This is where it gets really interesting. Let's compare the 2 most common types you're going to see out in the wild, and I'll use a real-world analogy to make it super clear. A traditional rights issue, that's like a personalized digital promo code sent straight to your email. You can use it to buy something cheap, but it's locked to your specific account. If you don't use it, it just expires. You literally can't give it to anyone else. But a renounceable rights issue, oh, that is like holding a physical golden ticket. If you don't want to use that ticket to buy the discounted shares, it still has intrinsic value. You can legally sell that golden ticket to your neighbor or even some total stranger on the open market. It gives you incredible flexibility because you can actually monetize your rights without spending a dime on the new shares yourself. Now, just to make sure you have the complete picture from the source material, there are 2 other variations you might hear about. Non-renounceable is really just the formal, fancy term for that traditional use-it-or-lose-it model we just talked about. You absolutely cannot sell or transfer those rights. And then there's the standby rights issue. This is basically a safety net for the company. A third party, usually a big financial institution, steps in and promises to buy up any leftover shares that the existing shareholders decide they just don't want. All right, Section 3, 3 shareholder options. So you get this offer in your inbox. What do you actually do? Well, you generally have 3 clear paths. Step 1, you can just subscribe in full. You pay the discounted cash price, you get your new shares, and boom, you maintain your exact proportional ownership in the company. Step 2, you don't exercise your rights. You just completely ignore the offer. But beware, if you do this, your ownership stake gets diluted. The company is issuing new shares to everyone else, which means your personal slice of the pie just got a bit smaller. And step 3, if the issue is renounceable, remember our golden ticket, you can sell those rights to someone else. Depending on market demand, you could actually make a tidy little profit just by selling the coupon itself. Next up, Section 4, the math breakdown. Okay, let's ground this with a simple, real-world scenario. Let's say you own 1,000 shares of a fictional company, XYZ Limited, and they are trading at 15 rupees each. So, your total value is 15,000 rupees. Now, the company announces a 2-for-5 rights issue at a heavily discounted price of 8 rupees. What does that actually mean? It means for every 5 shares you already own, you can buy 2 more. So you have the right to buy 400 new shares. You drop 3,200 rupees to get them. Afterwards, you now own 1,400 shares. Your new total portfolio value is your original 15,000 plus your brand new 3,200 investment, bringing you to 18,200 rupees. You've put in more capital, sure, but you successfully protected your exact percentage of ownership in the company. But wait a second, what actually happens to the share price here? Well, if we take your new total value of 18,200 rupees and divide it by your new total of 1,400 shares, we get a new theoretical share price of 13 rupees. The post-issue share price naturally adjusts downwards from 15 to 13. And why? Because those new, cheaper 8 rupee shares are now blended into the overall market. It's just a natural mathematical adjustment, guys. It's not necessarily a red alert that the company is failing.
Moving on to Section 5, the timeline.
So how does this actually unfold in the real world? The process kicks off with the announcement date. That's when the company goes public with their plan. Then comes the record date, where they essentially take a snapshot of the shareholder registry to see who actually gets these rights. But listen up, here is the critical one to watch, the X-rights date. This is the day the stock starts trading without the rights attached. If you buy shares on or after the X-rights date, no VIP discount for you. After that, we enter the subscription period, where you actually make your choice to buy or sell, followed by the allotment date when shares are handed out, and finally the listing date when those brand new shares hit the open exchange.
Finally, Section 6, why companies do this.
Let's zoom out for a second. Why does a company suddenly need a massive influx of cash? Well, there are a few reasons. Sometimes, troubled companies will use a rights issue defensively, to pay down crippling debt when banks refuse to lend them another dime. But often, it's actually an aggressive, positive move. Growing companies use rights issues to fund massive expansions, fuel research and development, or even acquire their competitors. And they get to do all of this without taking on high-interest loans that would just absolutely weigh down their balance sheets. So the crucial point is that rights issues offer some massive advantages for the issuing company. I mean, it is incredibly fast fund sourcing. It brings in completely debt-free capital. Plus, it incurs very low costs because they don't have to pay those huge investment banking or underwriting fees you'd see with a typical public offering. And importantly for you, the investor, it lets you maintain your ownership proportions rather than having the board of directors just sell off massive chunks of the company to outside venture capitalists. However, we do need to look at this impartially. There are for sure some distinct disadvantages. As we saw in the math breakdown earlier, the share price will almost certainly decline post-dilution. On top of that, stock exchanges usually put strict limits on exactly how much money a company can raise this way. And finally, you can't ignore the psychological factor. Asking your current investors for more money, it can sometimes look desperate. That can negatively impact the company's public image and send the stock price tumbling if the broader market just doesn't buy into their growth story. Which leads us to this final thought. If a rights issue lowers the stock price on paper and could potentially indicate that a company needs quick cash just to keep the lights on and pay off debt, is this VIP discount actually a red flag in disguise? Or is it a golden opportunity to double down on a business you truly believe in at an absolute bargain price? Well, the answer entirely depends on the fundamental health of the company handing you that coupon. Thank you so much for joining me for this explainer. Keep learning, and I'll see you next time.